Hello to all stakeholders of CMAYS Financial Limited. My name is Charlie May. I'm the Portfolio Manager and Chief Executive Officer of CMAYS Financial Limited. I'd like to thank you all for showing an extreme amount of interest in our new investment fund that we proceeded through 2017 to 2022. I'd also like to thank you all for attending this presentation today. So today we will proceed with the following information. We'll start off with an introduction on the investment fund. We'll follow through with economic environment, then we'll follow through with a benchmark analysis, then a timeline of the portfolio. We'll then go through the portfolio weightings, followed by a quantitative analysis of all the assets in our portfolio. We'll also do a quantitative analysis on all the benchmarks. We'll also do an analysis on the individual equities, followed by a quantitative analysis. Then we've got our key takeaways, then a final remarks page. So for a brief summary of the presentation, CMAYS Financial Growth Style Investment Fund was created with the goal of putting technology themes to the forefront of the fund. As we previously forecasted, technology is going to be a leading GICS industry in the coming years. We also focus the fund to ensure high returns, and we have provided significant risk-adjusted returns for the investors of our fund. So what happened economically and financially in the States and all around the world between 2017 and 2022? So at CMAYS Financial Limited, we analyse the economic environment, specifically the global world events and the US political and financial events. These all affected our benchmarks, they affected our portfolio, they affected our individual equities throughout our portfolio also. So beginning with the global world events, in 2018 there was a lot of protest and social angst against the global climate change protests. In 2019, the big one, COVID-19, it took down a lot of companies. It caused a lot of financial stress throughout the US economy and all throughout the world. I think we can all say that it affected almost every single person on the planet. It was officially announced by the World Health Organization in 2020 as a global pandemic. In 2020, a big one in the EU, Brexit officially happened and the UK leaves the EU. This caused a lot of internal trade problems between the UK and the rest of Europe. It also had a flow-on effect to the States as well. In 2021, big one for Pfizer and Johnson & Johnson, the COVID-19 vaccines rolled out. This was huge for putting down the COVID-19 pandemic, but it also did cause a lot of social angst between the government, these big companies, and the people of the States. In 2021 and 2022 also, there was a lot of conflicts in the Middle East and in Europe as well, between Israel and Gaza, and the other big one, Russia invading Ukraine, starting the Ukraine war. We then follow through to the US political and financial events. In January 2017, this is another big one. Donald Trump became the US president against the odds, against Hillary Clinton. Donald Trump became the president of the United States. In 2018, I beg your pardon, the US and China trade war began. This caused a lot of large tariffs. Tariffs put upon products and goods coming in and out of the States. In 2017 to 2018, Bitcoin and cryptocurrency became a big force throughout the currency part of the world. In January 2020, Donald Trump's reign as the US president ended and Joe Biden became the US president. In 2021, the Capitol riot in the US, Donald Trump didn't accept the fact that he lost the presidential race, and there was a big riot in the White House. 2021 also brought a big technological increase in the world. Meme stocks and cryptocurrency was surging dramatically during this time. In 2022, also global inflation increased significantly, and 2022 stock markets did decline. As seen in the portfolio pitch, CMAYS Financial Limited benchmarked its investment fund against the S&P 500 and the Nasdaq. The following graph on this screen portrays the bearish and bullish behaviours of the chosen benchmark, the S&P 500, during this investment period. On the next slide, we'll unpack the Nasdaq. So between 2017 and 2018, Trump was in office, so he carried on his reign until 2020, but the initial stage of his presidential reign, he's big on boosting American companies. So the S&P 500 did increase during this time. You'll see a green dash there. This was the continued raising of interest rates and the US-China trade war. This lost a little bit of consumer sentiment during this time. The S&P did drop off. You'll also see there in 2020, the start of 2020, COVID-19. It did see a big drop during this time. This wasn't just the S&P 500. Most markets did decline. In 2021, there was a huge increase in the S&P 500. This came about through Biden coming into office. This is also when the vaccine rollout happened, so people were recovering from the pandemic and people started to increase their consumer sentiment. And this is also when the tech stocks boomed. So big stocks like Apple, Tesla, these really took off during this time. You'll also see in 2021 at the end and the start of 2022, there was another drop due to an inflation rate rise and the Ukraine war. So our second benchmark fund was the Nasdaq. This fund is based on a more technological approach. You'll see in the graph, it's quite a similar movement to the S&P 500, but some of the drop-offs aren't so dramatic. So from 2017 to 2018, Apple stocks grew, especially with the iPhone X launch. Also during this time, NVIDIA AI improvements really increased. AI will during the investment time has been seen to have a much more large prominence during the investment fund. You can see that in between 2018 and 2019 there was a little bit of a drop off. This was due to tech regulation fears and a trade war between US and China. You'll see in the blue there, interest rate cuts support tech companies. So during this time also, it was pre-COVID. There was a big boost for the tech companies with interest rate cuts. You'll also notice that during where COVID actually happened, there wasn't a big drop-off because it didn't affect the tech companies so much. During the end there, in 2021, Apple, Microsoft, Google, NVIDIA, and Amazon reached record high, and Tesla hit a US $1 trillion market cap. This really pushed the Nasdaq up to the top and it reached its capacity. You'll also see after that, in the purple there was a big drop-off as well. This was due to rate hikes and also Meta, Netflix, and Zoom announcing weak earnings. So now we're going to focus more on actually what happened with our specific investment fund. So what does the timeline of our portfolio actually look like? So on the 3rd of January 2017, our investment fund initially invested $100 million into our fund. So that accumulated 1.07 million shares. On the 7th of June 2018, one of our assets in the GICS industry material asset, Monsanto, was bought out and delisted by a separate material company. The next day, we spent a lot of time analysing and evaluating, and we came to the conclusion we were going to make a new optimal portfolio fund. So we sold our initial fund for $147 million. The portfolio grew 47% during that time, so we were happy with that initially. So on that same day, we bought out a new optimal fund, and we established that as a company at a cost of $40.50 per share. So we sold the other one at about $119 per share, and we bought a new one about $80 cheaper. This allowed us to buy 3.6 million shares buying with cash. And on the 8th of June 2022, our proposed 6-year investment fund, we terminated it. The investment fund grew 329% from the initial 100 million, and it finished at a value of 428 million. So what did our investment fund look like for the duration of the whole period? So initially, you can see the GICS industries on the left. We had to choose one company from each GICS industry. It had to be a US equity. Also had to be a public company. So initially, it consisted of Coke, Pfizer, Microsoft, Tesla, Duke Energy, JP Morgan, Caterpillar, Monsanto, Chevron, Simon Property Group, and Netflix. In the middle there, in the green and the red, you can see which companies were replaced on the 7th of June 2018 and which ones were kept. So the companies that were replaced were Pepsi, Johnson & Johnson, Apple, Southern, Lyondell, Basel, Public Storage, and Nvidia. These were the companies that replaced the initial companies. On the right, you can see the new weightings for the portfolio. So the weightings of our investment fund, we initially set the benchmark that the minimum weighting would be 3% and our maximum weighting would be 40%. So you can see on the left there, the initial fund weightings were between 17 and 2018 as the following. You can see on the right, we changed the maximum and minimum weightings to 1% and 50%. You can see Apple there approximately taking up 47% of the weighting. We solved these through Solver and Excel, so we maximized the Sharpe ratio and we set the weightings to bring back the greatest return for the company. So we're now going to follow through with a quantitative analysis of the investment fund. So we're going to start off with the performance of the investment fund against the benchmarks. So initially, the investment fund was compared against the S&P 500 and the Nasdaq. So the main fund's annual return actually was 27.45%. The S&P's was 9.3%. You'll see that that's about 18% more per year. The standard deviation, the risk for the investment fund was quite high, 34%, 14% higher than the S&P 500. For the Nasdaq, on the other hand, the annual return was 14%, so a little bit higher than the S&P 500. The standard deviation and the risk was a little bit higher for the Nasdaq also. So now we worked out the expected return calculations. The risk-free rate we used across the portfolio, we used the December 2022 US 90-day Treasury bill rate, which was 4.25%. So the investment fund comparing against the S&P 500 accumulated a Sharpe ratio of 0.68. This isn't a great Sharpe ratio, as we prefer a ratio above 1, but it's not terrible. The S&P 500 Sharpe ratio was 0.25. The main fund's beta was 1.271 against the S&P 500. We accumulated an alpha of 0.17, which is quite good. And our main fund's CAPM against the S&P 500 was 10.67%. Against the Nasdaq, our Sharpe ratio was 0.68. The Sharpe ratio for the Nasdaq was 0.41, so a little bit higher than the S&P 500. Our main fund's beta was 1.151, so you can see that this our investment fund was quite closely related to the Nasdaq compared to the S&P 500. Our alpha was 0.12, slightly lower than from the Jensen's alpha calculated with the S&P 500, and our main fund's CAPM against the Nasdaq was 15.82%, which is really quite high. So how did each asset individually perform? Beginning with consumer staples, we initially had Coke and then we moved to Pepsi. Coke and Pepsi had a gradual decline at the back end of 2017. The new portfolio replaced Coke with Pepsi. Pepsi recorded a 77.56% price growth in the investment time. Pepsi also ended 2022 with a price of $181.98. The 6-year percent price change for the industry was 46.77%. Now onto our healthcare. So we started with Pfizer and we moved to Johnson & Johnson. These were major companies during the COVID-19 pandemic as they were distributors and manufacturers of the vaccine itself. Both of these companies were major competitors during this time. We started with Pfizer with a 3% and with our new portfolio, we changed it to Johnson & Johnson having a 1% weighting. Johnson & Johnson grew considerably by approximately 40% alongside the strong vaccine. The 6-year industry percent price change was 96.86%. Now moving on to information technology. So these two companies performed really, really well during this time. They had a 6-year industry percentage price change of 166.82%. So it started off with Microsoft but with our reanalysis and rebalancing, we chose to replace that with Apple. So Apple and Microsoft both had a significant price increase during this time. At the rebalance time, the sell of Microsoft and the purchase of Apple was the best option because of the largest gain. This resulted in 170.44% price growth for Apple. This was also the largest weighted stock in the portfolio with a 47.28% price weighting. So moving on to consumer discretionary. So Tesla was the stock that paid off the most. It had a 471.92% price increase. This was the second heaviest weighted equity in the portfolio. Tesla started with a price of less than $25 per share. It also peaked at $400 per share, greater than $400 per share. The price per share at the end ended up being $121. Tesla is a consumer discretionary company, but it's a heavily innovative and tech-based company. So that's why we chose to have a high weighting in our portfolio. The 6-year industry percent price change was 54.7%. Tesla beat that by almost greater than 400%. Our next company was in the utilities industry with Duke Energy switching to Southern. Duke actually underperformed and was replaced with Southern with our portfolio rebalancing. This was a good decision as it was bought low and the price ended high with a 66.8% growth. This company was heavily impacted by COVID, as you can see in the graphs. It had a 6-year percentage industry price change of 47%. Now moving on to the financials. So we stuck with JP Morgan over the whole investment period. This company is one of the leading financial firms around the world. It had a low weighting due to the lower growth and it's not really tech-based. JP Morgan was severely impacted by COVID, but it had a really, really good bounce back after COVID. The 6-year industry percent price change during this time for JP Morgan was 46.4%. Moving on to industrials, Caterpillar we stuck with the whole time as well. Just like JP Morgan, we stuck with a 3% to 1% price weighting. The industrial industry rose in late 2017, then dropped heavily beginning of 2018. Caterpillar grew 53.47%, extremely good post-COVID. It did have a low weighting, like I said. The industrial percent price change was 47.08%. So now moving on to materials. So Monsanto, the company that we've all been talking about this whole presentation. Monsanto was bought out in the 7th of June 2018. We sold this company at a high price of $127.95. We then bought LYB at approximately $80 per share. Unfortunately, the materials industry didn't do great during this time, and LYB decreased 30%. We stuck with Chevron in the energy industry the whole time of the portfolio. It was a high-performing energy equity for their industry, actually. They had a lower weighting because of their lower growth in comparison to the other equities in our portfolio. Chevron had a high drop-off after COVID, but did really, really well to rise back post-COVID. The 6-year industry percent price change was 18.96%. Now onto the real estate industry. We began with Simon Property Group. Simon Property Group was quite an expensive stock. They dropped off heavily in COVID, which was probably a good decision in hindsight with the rebalancing, switching to public storage. SPG initially had a large stock weighting of 24.57% because of the recent growth. It fell short in 2017 with a 9.7% decrease in growth. So this is where we swapped out public storage. We replaced public storage. Public storage performed extremely well for the real estate standard. They increased by 30.49%. The 6-year industry percent price change was 22.9%. So now on to our last industry, the communication services. So Netflix, we initially they started at a low price, but we switched it into NVIDIA because of the tech-based and for the AI transformation industry increasing. We initially had a high weighting due to the high growth of Netflix, but please note that Netflix doesn't pay dividends, and that's not the purpose of our portfolio. We sold Netflix at a high price before the price decrease in 2018. The NVIDIA purchase did pay off with a 122.71% growth price rate. This was also way better than the industry standard of minus 11.42%. So we're now going to perform a qualitative analysis of our investment fund. So what actually happened during the period of our investment fund? Although the initial value of the fund was $94.53 and the final selling price was $117, the high $139.68 sell in June 2018 and the new investment into the portfolio allowed for an extremely high 6-year return. The initial $100,000 actually turned into $428 million. The initial investment grew 328% from the $100 million to $428 million. The initial investment bought 1,057,000 shares. So now, what do we actually modify to maximise the returns? So with our investors and our shareholders at the forefront of our decisions, we modified our initial assumptions to maximise the returns for our shareholders and investors. So we changed the high weighting for the tech firms. So we made Apple really high, and we also made Tesla really high. We chose stocks that responded well to COVID-19. We raised the max weight threshold, and we lowered the minimum weight threshold. So we've got 8 key takeaways from today. We've made a $328 million gain from our initial $100 million purchase. We owned 3.5 million shares. We had a 328% gain of our portfolio. The GICS gain was 69%. We also can note that our key industries soared. Our alpha against the NDX was 0.12, and our alpha against the S&P was 0.17. Our CAPM against the NDX was 15.82, and our CAPM against the S&P was about 10%. So on the 29th of December 2022, CMAYS Financial Limited, we've made the formal decision to terminate the fund on the day. This gives each shareholder of the fund the following. So first of all, the growth of 328% per unit invested. So if you invested $100 million, for an example, you would have gained $328 million as a result of the final performance. You would have also gained a strong consumer sentiment and a strong trust in the tech industry. So that's a wrap. Thank you so much for watching this presentation, and also thank you for investing with us. We look forward to working with you in the future. This has been Charlie May. I'm your portfolio manager and would love to work with you again in the future.